Welcome back, everyone. In this video, we're going to break down the concept of fair value gaps, often referred to as FVGs. We'll cover exactly what a fair value gap is, what an inversion means, and also discuss the distinctions between a fair value gap, a traditional price gap, and a volume imbalance. Now, let's begin with the foundation. What is a fair value gap? Well, a fair value gap is a three candlestick formation that occurs when the price action fails to fully overlap across those three candles. Specifically, the low of the first candle does not overlap with the high of the third candle, and the high of the first candle does not overlap with the low of the third candle. This lack of overlaps create what we identify as an inefficiency or a gap in market structure. Now, let's take a closer look at this with an example. If you were to observe this candle's low and compare it with the following candle's high, you'll notice there is no overlap. This creates a visible imbalance across the three candle sequence, which qualifies as a fair value gap. Here's another example. Again, the high of this candle fails to overlap with the low of the candle 2 bars later, leaving space in between. That empty space is the gap we're referring to. On the other hand, let's look at what does not qualify as a fair value gap. Suppose the first candle's low and the third candle's high extend to each other. In that case, the price action overlaps, eliminating the gap because there is no inefficiency between those three candles. This setup would not be considered a valid fair value gap. The same rule applies in the opposite direction. If the high of the first candle and the low of the third candle overlap, there is no gap, therefore, no fair value gap. To summarize it, a fair value gap exists only when there is a clear imbalance between the first candle's low and the third candle's high, and simultaneously between the first candle's high and the third candle's low. That is what we call a fair value gap. Now that we've established the core concept, let's move on to a few more examples so you can see how a fair value gap appear in real price action. Okay, now if you were to look, you see that the high of the first candle and the low of the third candle do not overlap, therefore leaving a gap in between the high of the first candle and the low of the third candle, making a fair value gap. Now, if you were to also look at this one, you'll see that the low of the first candle and the high of the third candle does not overlap, making a next gap and making a next fair value gap. Now, if you were to look even closer, you'll see that price made two fair value gaps. You have this one with the high of the first candle and the low of the third candle. You have a next one again with the high of the first candle and the low of the third candle, therefore making two fair value gaps, two gaps in between the candles. You have the first fair value gap here, and you have the second fair value gap here. All right, so the next thing we're going to look at is an inversion, also known as an inverse fair value gap. What an inverse fair value gap means is that the fair value gap failed or price did not respect the fair value gap at all and closed above it. What I tend to look for in an inverse fair value gap is that price either return back to the gap for support or it returns back to the gap for resistance. Price would often break through the fair value gap and return back to it to then retest it and then continue the trend elsewhere. All right, now that I've demonstrated on what an inverse fair value gap is, let's open a chart and look at some examples of what an inversion is. All right, on this chart, you'll see that price made a clear bearish fair value gap. And you'll notice that price did not respect the fair value gap at all. The fair value gap failed and price just broke straight above it. You also notice that price then later on returns to the fair value gap to then use as support. So price broke above the fair value gap and then later came back to the inverse fair value gap to then use it as support to then go back up. So we have price went down in a bearish trend, made a fair value gap, then price broke above the fair value gap, then switching this fair value gap to an inversion, also known as an inverse fair value gap. Then price then came back down into the inverse fair value gap to retest and continue the trend in the upwards direction. All right, now let's look at a next example of an inversion. Your price made a fair value gap within these three candles. And then you'll see price broke through the fair value gap, therefore turning it into an inverse fair value gap, to then come back into the fair value gap to retest, and then come back down. So you have was a fair value gap, price broke past the fair value gap, making it into an inverse fair value gap, and then came back in right here to retest the fair value gap. Okay, so once again, we have a fair value gap within these three candles. And you'll notice that price then breaks below the fair value gap, making it into an inverse fair value gap. You'll see that price later on returned to the inverse fair value gap and had a reaction towards the inverse fair value gap. So we had price made a fair value gap within these three candles. Then it shifts and broke below the fair value gap, making it into an inverse fair value gap. And then price went back up to the inverse fair value gap to then have a rejection. So you have fair value gap, inverse fair value gap, and rejection of inverse fair value gap. All right, before we wrap up this video, let's clear up one last thing. The difference between a fair value gap, a volume imbalance, and a standard gap. Now we've already gone over what defines a fair value gap. So let's turn our focus on to the other two. A volume imbalance happens when there's a price difference between the close of one candle and the open of the next. But here's the key. Unlike a traditional gap, there's still some trading activity in that zone. You'll often notice some overlap between the high and the low of those two candles, meaning that the market was active even though it wasn't perfectly balanced. A gap, on the other hand, is a completely different story. This is when there's zero trading activities between the candles. Price literally skips over an entire range, leaving a blank space on the chart. So remember this. Both look like price displacements, but the difference is huge. A volume imbalance shows us there was still participation in the market. A gap shows us that there was none at all. And as a trader, knowing which one you're dealing with makes a big difference on how we approach the setup. Okay, so if you were to take a look here, you'll see that we have two examples of a volume imbalance. We have an volume imbalance within these two candles. You can see price closed here, but price ended opening up down here. And that's considered a volume imbalance because price did not open next to the close. It dipped down here and opened here. Even though it opened down here, price still traded within the gap. And that's an volume imbalance. Over here, we have a next one. Price closed here and price opened down here. But there was still trading within this gap. You can see the wick through this gap that shows us that trading still took place within this gap. Now let's look at a few examples of a standard gap. Okay, so here's an example of a standard gap. You can see price closed here, but when price opened back up, price jumped all the way down here with no wicks or no trading activities involved. Price just simply skipped all the way down here and end up opening here. You can see price closed right here. The lowest wick was right here, and then price just jumped all the way down here. Now, a thing about gaps, they usually tend to happen um at the beginning or at the opening of a new daily candle. That's when they usually happen. So you can see price closed here 4:46 p.m. and when 50 o'clock or 5:01 hit, price jumped all the way down here to then open. And that's a wrap for today's session. We went over fair value gaps, inverse fair value gaps, volume imbalances, and standard gaps. And now you should have a much clearer picture of how each one shows up on the chart and what it really means for price action. If this helps sharpen your understanding, don't forget to like and subscribe so you don't miss the next breakdown. We'll keep diving deeper into advanced trading concepts step by step. And most importantly, don't just watch. Go back to your charts and practice spotting these setups for yourselves. That's how the knowledge actually turns into skill. This is the Trading District, and I'll catch you in the next video. See ya.